Hi, everyone. Welcome to the Enquiry. Thursday, 2nd of February, Lisa and I wanted to cover unicorn or de-unicornification, the problem around startup valuation. Hi, Lisa.
Hi, Sabine. And I love that you picked no better word for this topic than one that, as everyone's like, how do you pronounce de-unicornification?
I know I had to
What a
repeat
great
it
way
quite a
to
few
enter
times.
this inquiry.
I had to repeat it quite a few times to get it in my head, de-unicornification.
There we go.
We have a French word saying anticonstitutionnellement. This is the longest word in French. So I had to train myself.
That's a good training. My best one is supercalifragilisticexpialidocious.
So why did we pick that topic? I mean, beginning of the year, finally I wrote my article around my prediction, and I tried to keep it a little bit more socially focused. One thing I realized is that when I looked at the CB Insight reports, which were the state of venturing and the state of fintech, I could see that there were some major drops in valuation, but also in investment in startups. So if you don't mind, I will just start with a few numbers coming actually from the CB Insight piece of research.
Yeah.
So in the State of Venture report, they highlighted that actually the market for foreign funding contracted by 19%, Lisa, quarter by quarter in the Q4 of 2022. Today, 415 billion US dollars have been invested in startups in 2022, a drop of 35% from 2021. Now, looking at fintech, and I look at the fintech numbers, when you look at 2021's number, fintech raised around $150 billion, and this year's $100 billion, which represents around a 35% drops as well. Insurtech, unfortunately, moved from 17 billion investment funding in 2022 down to around 8 billion in 2021, 8 billion in 2022, which for me represented around a 53% drop. Now let's look at the fundamentals. So what do you think? And also, why are we selected the Warrior song today, Lisa?
So, I mean, I love that prompt. You know how to prompt me, Sabine. So I mean, okay, so let's talk about the Warrior, and then let's kind of reflect on these numbers and trends that we're seeing. I've told this story to you, Sabine, but let's share it with the people that are joining us live today on the Enquiry. There's this passage in Game of Thrones, and whether you've seen Game of Thrones or not, it doesn't really matter. But the analogy here is, Khaleesi, mother of dragons. And I think it's so relevant to unicorn because of the mystique and, in essence, the extinction, or dragons, of course, in those days and times lived, and then they were no longer. And so Khaleesi, in something that you might consider like an extinct innovation, we could kind of relate to this, the insurance industry, kind of the too big to fail concepts. Khaleesi takes these eggs, and through fire, which, we could get into the Phoenix a little bit, but through fire, she creates life. And basically, of course, then she has dinosaurs. She has dragons. My brain. I'm on extinct right now. She's on dragons. And I think the metaphor here is what level of Phoenix and heat do we need to apply to see this birth, if you will? And we can very much liken that to unicorns and what we're looking for in unicorns. And so, first of all, it's super important. And I think that we as industry veterans, Sabine, you know how much you and I love this industry and how much we devote ourselves to this industry. But I think what we're seeing in valuations, and of course, I used to do mergers and acquisitions and valuations, and most people don't know, but I did have a CFO title at a couple of companies, wink, wink. But I think what we're seeing right now is a somewhat of a reset. And I would actually like to talk a little bit of the drop in investing, the drop in valuation, but the uptick that we're seeing in mergers and acquisitions.
Yes.
And so I'll kick it back to you, because if we put all these things on a balanced scale, like a teeter totter, and what we're seeing is, in some cases, fire sales, but more particularly, I think we're seeing an acquisition appetite for how would I acquire certain components to build something that interests me. So I'll kick it back.
Well, thank you, Lisa. I mean, I think it's important to go again into more numbers. And I know as a CFO, I thought that would be the perfect topic for you, as you know, we'll need to look at valuation when we're starting helping those startup even with fundraising, right? So some of the highlights are that last year there were 548 startups, global, fintech, insurtech, all of them that became unicorns. And this year the number went down to 227 unicorns, no, 252 unicorns in 2022. And this is a major drop. Now, when I was looking at the unicornifications, you know, those who lost their 1 billion valuation is much more difficult to find, because the valuation is defined, you know, you have a pre-money valuation and you have a post-money valuation, which is determined with the investors. The one, you know, have disappeared are the one who pretty much do not exist anymore. However, when you start also diving into the reason why some companies are losing that status, it's because of, you know, needing for restructuring, and you can look at the headcount reduction. So there are signals you can actually see out there, you know, change of products, you know, making choices which may not be the most relevant for the current market. I would say as well, potentially managing lawsuits and, you know, delivering unprofitable initiatives. And all this relates actually, Lisa, as you know, to making choices around the right business models, solving the right customer problems, building the right culture, and also focusing on profit and unit economics. Now, to go back at your question around M&A, there was the biggest year for M&A in insurtech. 81 deals were made in 2022.
Yeah, which I think is very reflective and signaling to the market. And what the market is saying is, and I'm going to come back to the valuation in just a minute. What the market is saying is we have a need for certain types of solutions, you know, be it technology, be it distribution models, be it, you know, new product innovation, product development, you know, data, all these things. But it has to fit into a unit economic that makes sense for us as, you know, insurance carriers, reinsurers, brokers, et cetera. So you saw a huge uptick in acquisition and M&A. And of course, I mean, that's just natural to see when the market starts, I'll call it like resetting valuation. And I was just here with like a lot of investors at this event that I'm attending, and they're calling it a return to normal, right? So as opposed to this, you know, maybe framing, and I'm not to say it's not difficult if you were one of the unicorns and you got devalued, but as opposed to this, you know, fall from the sky, you know, the dragons are not falling from the sky, they're actually flying and they're out there. As opposed to this fall from the sky concept, it is more a return to what people would say are, you know, proper economic ranges, right? The which, you know, I didn't hear any investors talking about things that were out of range. There have been, of course, a couple of fire sales that you and I know of in the industry. I think those were, you know, factored into business model fit and you know, valuation concepts. Mm-hmm. But if we just step back for a minute, you know, and I'm going to actually ask you a question to answer a question, and then I'll come back to it. You know, okay. How many pitch decks, go-to-market strategy, raise decks have you looked? And what's the number every single deck says they're going to achieve?
Oh, wow. Yeah. I mean, yeah, a big number. So originality, indeed.
And I kind of like, for any people that, you know, come to me for advice or anything like that, and I always say, could you please give me something that doesn't equally sum to 100 million? Which, of course, you know, that's the unicorn valuation, because you take a 10x multiple and you get to $1 billion. So just like, you know, can thread the needle here for people who are listening in who may not have done those decks or reviewed those decks. Now, is it logical to think that all the startups that we see and interact with and engage with can all achieve 100 million in ARR to get this 10x multiple to achieve a $1 billion in valuation?
It is, I think it is where, I mean, the crux of the challenge actually is, because when you start looking at the technology which is coming to market, I think from, doing work around insurtech disruption and synthesis with Bias Business School, what we saw is that, 70% of the applications that comes out there are very much about process efficiencies and running the business, leveraging technology to do things better, answer the customer needs better, and reinvent the customer journey. So I want to call them bundle and rebundle the things. I would say 30% of those would be more disruptive and owning the full stack end to end. However, it's not just about owning the full stack. It's also about driving, understanding how insurance works, which, I've made that mistake when I was working with my startups, talk about GWP and you talk about revenue and said, okay, it's simpler to understand, but GWP is not revenue.
Right.
And I think a lot of startups made the mistake to think that GWP is revenue, and therefore, as calculated for investors, numbers in the wrong way, resulting in poor results. And I'm sure if Matteo Carbone would be listening to that, he would agree. Even though everyone would be in insurtech some days, or everybody would be a fintech, because we all will be doing payment, like Angela Strange, highlighting from Anderson Horowitz. One thing is, dividing and separating the operation from the true transformation, I think.
Which is so true. And, we've been kind of talking about, what are you advancing digitally versus what new market mass are you achieving, either at, adjunct to the insurance carrier or maybe as an insurance carrier. We'll come back to that. And, I often found that a lot of target addressable markets and valuations were taking something on a P&L. To your point, it can be GWP, it can be total claims paid. I love that one. That's one of my favorites. And a lot of people take a percentage as a target addressable market, which on one hand, I often say, well, do you understand how your solution would transform the needs to, like, by the way, it's never going to be a percentage of claims. It's never directly going to be a percentage of premium. Like, insurance companies are very sophisticated at how to optimize their balance sheet and P&L. Like,
they're a finance company, right?
Financing is the bedrock of insurance, right? We took an intangible and made it an entire multi-trillion-dollar industry. So I'm not saying we can't incrementally improve. Of course we can, but I liken that to more concepts of leveraging our resources, right? So to truly transform and to truly get into the unicorn status, you have to be cutting across multiple things. You have to be able to offer products and solutions in ways and reaches that couldn't be offered before.
Yeah.
You need to have, to your point, a very robust operating model. And that's not just customer acquisition. You have to penetrate that all the way through to operations, all the way through to the ERP and the financials. You have to be able to have a very, engaging, unique customer experience model. And so I've seen a new trend now where, and it's because of this valuation inflection point that we're in, where investors, and I would say maybe this is a little bit more on the PE side, but I'm also starting to see it in venture capital as well, are asking founders, well, instead of asking for 2 to 3 million in a raise, whatever, like an extension round or whatever, why don't you ask for 10 to 20, whatever that number is, and actually build a stack, an insurance stack, which is incredibly interesting. And I don't know if you're seeing that, because I'm definitely seeing that over here in the US. I don't know if you're seeing that, in Europe. Because clearly some of the unicornifications that have happened are full stack carriers. And, the almighty loss ratio and cost of customer acquisition always reigns, right? There's, one of our good friends, Gloria, she always says, there's no escaping the economics of insurance,
And that's the key thing. There is no escaping the economics of insurance. So in Europe, investment patterns are slightly different from United States. I think American investors have been doing that for a while and are prepared to give bigger checks. In Europe, it's less so. And it still takes 10 to 20 million to build a full stack. So I would say you see that less in Europe. However, I wanted to mention something which probably might be surprising for some, but has been a long time coming, is that in Africa, past 2 years, African fintech startups were able to raise, and in general, the startups in Africa have been able to raise up to 3 billion over the past 2 years. And some of the major raise have been able to go up to around 15 million, which is rare in Africa. It means that the solution has really, according to the investor, great market sizing, tam sam sum. They have a great potential for growth, and it tends to land into payment and fintech than into other spaces. But I would say there's still some way to go for European investors who are still a little bit shyer in the amount of money they are putting in startups in Europe.
Yeah, and I think that the funding sources, so that's interesting, with the kind of like the US lens versus the Europe lens versus Africa. And I know quite a few startups that were expanding in Africa, and I think that's very much an underserved market. And I think that there's a lot of if you look at the population and the ability to penetrate, there's less saturation. So if someone could serve that market in an effective and in an efficient manner, then there is definitely, I would say we'll probably see unicorns arising out of that cohort. What's interesting is if you're listening to this as a founder, is that you're all of a sudden faced with new decisions as you're maybe looking to extend your round or as you're looking at your cap table. And these decisions are, getting more into the well, I may have thought that I was going to partner with someone that would do distribution, that was going to have paper, that was going to give me capacity. And do you value your company at X, or which is without those things, or what's the cost of capital to build those things and go to market? And then what is your business model and your target addressable market? So I kind of wonder if we're about to see more scaling as a service or more full stack as a service, which would be basically a fractional model to say, okay, if the investors want to reward that, is there a kind of a unified way for insurtechs to connect into that without every single insurtech having to create those vehicles, capacity, et cetera, themselves? And then, of course, Sabine, I'd love to hear your thoughts on that. Then if they do go down that model, what would that mean for valuations? If there's this if you think about it like that as full stack as a service, then how would we fractionally value that? And I'll turn it back to you, because I think that's a really interesting thing and not that dissimilar to what we saw with business process outsourcing, maybe 10, 20 years ago.
Yeah, I would say that thinking about your question, so would a full stack proposition succeed, as long as I guess it has the fundamentals that are required to build a successful business, which would be, looking at how you use that full stack with the right amount of resources, so operationally efficient, and also being able to return what is required, which is profit. And for a long time, insurance has not done profit from underwriting, right? Profit comes from their great financing skills. Right. Often people don't always know that. Now,
the magic of the balance sheet, the leverage, how we leverage our balance sheet and capital plays is, so even financially motivated reinsurance and all the ILF structuring and everything. It's all about capital management. And clearly losses affect that, right? But how we manage our balance sheet and what capital we have to deploy is a huge pinnacle. And of course, you and I know that, investments, where are we deploying our investments? How are we deploying our investments? what's the yield curve on investment earnings right now in this economy that we're in. All those things strain the economics of insurance.
Yeah. So when you look at the full stack question, is I do think there is value around serving a very specific customer segment in a very unique way, but it has to be a large market size, and then identifying serviceable, addressable market, and therefore what the company is going to be able to grab within that market. So I call it the sliver proposition. But now looking at it from an investor viewpoint, for a long time, investors are only focusing their attention on SaaS business models.
Yeah.
And so, recurring revenue, AIR, annual recurring revenue or monthly recurring revenue for, with low CAC. And so is there a need to change the mindset of the investor? That also is a question, because when you look at insurance, you need to understand the different model, broker, MGA, full carrier. And, last year, past 2 years, MGAs were very, very hot. Are they going to still be hot in the next few years? I don't know. I don't have this answer. But as a distribution model and being able to access specific target market with the technology supporting that, because a lot of insurers cannot afford to build a completely new proposition end to end, that becomes a very easy way to enter a new market, as you said, market access, with limited investment. So for me, is full stack the way to go? It might be. I always wonder and compare it to the payment platforms. A lot of payment platforms succeeded, but a lot of them have failed. Yeah. So what is the right recipe? Still undefined.
I think it's interesting too. Like, I also think that a lot of insurtechs, it's like, let's just use the word disrupting. Like, what aspect are you disrupting? And a lot of times I hear, well, like, we're making it digital. And I'm like, okay, but what are you disrupting or transforming? Like what unicorn is going to fly in the sky, like, when this is done? And I think a lot of insurtechs sometimes straddle, like, I'm disrupting distribution. I'm like, well, are you? Well, we got this whole digital thing. And I'm like, well, and we're going to use this, new customer acquisition. I'm like, well, are you just disrupting the cost of customer acquisition? Are you disrupting underwriting? Are you able to have insights that drive different risk decisioning? So as we can, or are you totally coming up with a new product that you need paper distribution and capacity? Sabine, you're the queen of category creation. So you're actually creating a new category that needs these things to get to market. And so I think the dilemma or the focus should be on knowing very specifically what the insurtech is focused on, because that's actually feeding into valuation, right? Like, it's investors, of course, are saying, are you a SaaS company? And I don't know about you, Sabine, but I worked with several insurtechs, and I'm like, I don't know that you're actually a SaaS company, right? Like, there are some that are, but a lot are not. But it was, to your point, kind of like when MGAs were hot, being a SaaS company got you certain valuations, and that's why the hyper focus was on ARR, right? So I think we're entering a world now where investors, and I just heard this reflected in the last couple of days, investors are looking at a very segmented understanding of what you're really, what your solution is really bringing to market, and then they're going to value you, and the cap tables and the valuations that they're going to expect will be aligned to that segment. So it's definitely a know thyself moment. And I think being all things to all people and kind of, pivoting, like, we can be all, I think now is the time that insurtechs and their partners need to get very specific about the problems that they're solving, because the valuation will, of course, economically follow those. And I fundamentally believe that this reset that we're seeing is aligning, kind of calibrating, if you will, these models into kind of, where the market is. Now, I'm not saying they're going to stay at these depressed levels, but I do think that the market is going through a calibration right now.
Yeah. So an interesting thing as well you highlighted, I just went and looked into some of the numbers, actually, and I was on the my fintech page, and there has been already probably 50 to 60 acquisition since the beginning of the year around fintechs. Insurtechs already has nine acquisitions since the beginning of the year. You probably remember the Duck Creek one, which was announced recently. And one of my dear startups, which I really, really like, was Anorak, has been acquired on 25th of January. Probably people don't realize. And today, Le Lynx en France has been also acquired by Grupo Montuy Online. So, the things is going on, right? There's a lot of acquisition and a lot of businesses are being acquisitive because the companies are probably really cheap. Still, because we are suffering from inflation and high interest rates still, therefore having a high cost of capital, which means that there are deals to go after. And probably why there were 81 acquisition just in 2022. Now, the fundamentals you mentioned around business models. One thing I also wondered is, when we started seeing insurtechs, everybody wanted to get rid of the broker channel, which is maybe a little bit arrogant, but why not? Because we've been successful in doing so in some ways in the UK, even though the aggregator is a former virtual broker. But what we are seeing is potentially what is a business model of the future, which needs to be customer-centric, customer first. We'll still need to have that distribution. We'll need to actually understand not only how to do unique customer engagement, friction-free customer engagement as part of that business model, but also having the great tech, maybe the ChatGPT, I don't know, in the back end to actually make sure that the infrastructure support the business and what it is delivering to the customer. So probably, hopping between the two, still thinking, is it a full stack, which is required? It might be, but it needs to be supported with the right financials and unit economics and profitability metrics.
Yeah, it's definitely time to, what we used to always say is like sharpen that pencil, right? It's definitely time to sharpen that pencil and get serious about not only common concepts like burn and runway, but really economic value, because the valuation you will be receiving isn't just on sales. It's going to, of course, include the economic value you are contributing. And I think, yes, you have to have revenue. Yes, you have to have the multiples. Yes, you have to show year-over-year growth. Yes, XYZ is not an excuse, right? Like, it's very linear right now, right? Like, to quote Jerry Maguire, show me the money, show me the economics.
But question for you though, Lisa, you having been in finance for a long time and looking at the market of the United States and the way investment is being made, do you think that you have seen from the past 2 days you have gone through with the investors, can you see a change in pattern? You already highlighted it, but do you see a long-term change in patterns the way they are doing this, or are we going to go back in the old approach of investing? Because in the US, you guys, I'm sorry to say, you can invest from a PPT, which is unlikely to happen, for example, in Europe, except if you have a serial entrepreneur and somebody who is very well known in market.
Okay, so I think what we will not see is the return to these just stargazing chasers of, I've got a PowerPoint, I've got a Figma screen, let's build it, Field of Dreams, they will come. I think that we are definitely seeing a return to discipline. And quite honestly, it's not that investors, we had a long conversation about this at this workshop. It's not that they don't have capital to deploy, because there is dry powder. Like, everybody knows there's dry powder. There's dry powder. But right now, LPs are asking the VCs, what about our current portfolio? And, is it, I think of it as, everyone in the room put their hands over theirs when I said this, because, I'm from a CFO background. I'm like, are there write-downs involved? What do we need to be thinking of? And so everyone is looking for, triage and management of valuation that's existing in their portfolio. So that's step A. That's what everyone is focused on, because you know how it is. We all answer to somebody. We all have a boss. So, VCs have to make money for their LPs, right? Like, we all answer to somebody. And so I think that that's going to continue to occur. And I think the second thing is there is capital to deploy. And the capital that will continue to be deployed will be for, good economic, rational business models. It's bringing that back into focus. So if you've been able to show year-over-year growth, or you've got a good revenue projection and trajectory, and your cost of operation is low, then I think you are a great target for investment and, or, I'll call it wholesome acquisition, not fire sale, right? Like I definitely see that being a pattern in the US.
And also, we have repeated it quite a few times, but probably not being in a hurry to take investor money and have the right fundamentals, already set. I love that story from Melanie, from Canva, who Melanie Perkins, right, from Canva, who didn't take investor money because as a female founder, she found it very difficult to get that investment money. But today, this company is number one unicorn led by a woman, and this announcement was made earlier this year, so it's a 2023 announcement, so one which has been unicorned and fully unicornified compared to others. What would be the three last points we could make as we leave this discussion, Lisa?
So I think first and foremost, innovation, ingenuity, startups, entrepreneurship, founding companies is here to stay. The market is not changing that, right? I would say out of the greatest need begets the best ingenuity. Society has always flourished in times of what you would think of as are bad times, right? And I think that's been quoted all over. So I think the top things to pay attention to is know thyself. What economic value is your solution delivering? And don't try to be all things to all people. Understand your burn, understand your valuation, and understand your cap table. And don't just be seeking, what we call payday. Like actually focus on something that's strategic. And you as the founder need to have enough runway to be able to make strategic decisions with your company, especially right now. And I would say the third thing is, confidentially, I've been approached by a couple of companies who are not in any distress. They have plenty of runway. They have great product market fit. They are doing amazing things. And they are actually saying, we want to explore M&A. So my third point would be, when you're not looking is usually the best time that opportunities to present themselves. So, that kind of aligns to the the greatest ingenuity comes out of times like these. When you're not looking is when it's probably best to consider an offer to maybe, through M&A. So back to you.
Well, I would say that, I'm still looking at those unicorn numbers. So in insurance or in InsurTech, we used to have 43 unicorns. Those are down to 35. And so we'll need to find out which one have disappeared from that table. So maybe a job to be done for a blog. The next version of the Khaleesi come together. Well, Lisa, we are on time, so let's say bye and let's plan to meet again in 2 weeks' time. And we'll ask our contributors to share with us the topic they would want to talk about next.
I love that idea. It's awesome to see you, my friend.
Awesome to see you. Bye.
Bye.